Real estate investment presentation, shared appreciation mortgage or SAM. Get ready because we're raising the stakes with real estate. As we expand on the shared appreciation mortgage or SAM, remember that working practice problems can help us get a better idea of them. We do have practice problems related to them. Also note that whenever we're looking at something that's going to be a deviation away from the norm, in this case the norm being a 30-year fixed rate mortgage loan, then we want to think about that as the baseline in our mind and think about what the differences are from there, that making it easier for us to build on the concepts that we already know. We're going to be referencing Investopedia whenever you have definitions that are investment related. Investopedia is a place you can go to continue your research. So the shared appreciation mortgage or SAM, S-A-M, the borrower or purchaser of a home shares a percentage of the appreciation in the home's value with the lender. That's going to be the basic idea of it. So you could imagine a similar type of situation where the owner comes in or the purchaser is asking for a loan, purchaser saying, hey, I would really like to get a lower rate or a smaller payment. And we've talked about some adjustments that could happen, adjusting some of the risk from the lender to the borrower to make that happen, which might be an ARM, adjustable rate, or you could have an adjustment of the payment, a PLAM, or now you can imagine a situation where the lender is saying, hey, I would like to get a piece of the appreciation in the property, that being the general idea. We believe that the property value is going to go up because property typically does go up. And if you give us a piece of that increase in the value of the property, then we can possibly give you more favorable terms, possibly lower rates, lower payments. So that's going to be the general concept. Now, these are not as standardized as some other types of loans, and you can imagine different structures in terms of how you would set up the terms for this kind of concept. For example, some questions that might come into your mind would be, well, what would happen if there was a depreciation, if the value of the property went down, which isn't the typical case in real estate, but can happen. In that case, you would think that you would not be having to pay for the appreciation in the property, but you want to make sure what the terms are there. Another question that might come into mind is, well, how long do I have to hold the property? If I agree to give you, the lender, a piece of the property at the point of sale, what if I just hold it on to the property until I die or something like that and never sell the property? Then the lender might not ever get their piece of the property. So typically woven into the contract in some way, shape, or form, the lender is going to be saying there's some kind of time, constituencies, and so on. The next question that might come into mind would be, well, what if I want to keep the property after some point in time and not sell it? Then you might think that there might be something in the contract that would basically say that in that instance, you might be able to pay off the appreciated value, possibly take an appraisal or something like that. So you can see the different kind of dynamics that could go into it, and you could have different structures of this type of loan. However, the concept of it, of course, being the lender getting a piece of the increase in the value of the property in exchange for a lowering of the payments and the rate. So the lender agrees to charge an interest rate that is below the prevailing market interest rate. So in other words, if you looked at the 30-year fixed rate, then of course you would assume that if you had a SAM, you would be getting a more favorable rate in exchange for this understanding or this deal. Understanding shared appreciation mortgages. It differs from a regular mortgage during the resale of the property. So most of it, if you look at the calculations, it's a lot more simple in terms of thinking about how to construct an amortization table, for example, than some of the other types of loans, such as an ARM or a PLAM, meaning the actual construction of the amortization table will be straightforward, similar to a 30-year, because the rate will typically be fixed generally, as well as the balance and so on. So it's going to be a fairly straightforward process. So when does the change come in? In this case, it's going to come in when you sell the property typically, because when you sell the property, that's when you're going to realize the increase from the value in the property, if there is one. And that's when you will owe back to the bank not only the loan that you still own at the point of sale, but their portion of the appreciation, the gain, or rise in the value of the property. So with a standard mortgage, the borrower pays the lender the principal owed on the loan plus interest over a set number of years. So if it's a 30-year standard loan, term loan, set rate, then normally you just pay back the loan. Of course, you're paying back the interest and the principal of the loan the lender making back their principal plus the interest, which is their earnings for their efforts. When the borrower sells the house, the proceeds from the sale are used to pay off the mortgage if there is still a balance owed to the bank. So in other words, if you got a 30-year loan, just a standard loan out, and you were to sell it after 15 years, for example, you would typically still have a loan out balance standing, and therefore when you sold the house, you'd have to take the proceeds from the sale and pay off the portion of the loan that had not yet been paid, and the rest would be basically your proceeds, and then you'd figure out your taxes and that kind of thing as well. Understanding shared appreciation mortgages continued. With a SAM, the borrower agrees to give a portion of the home's appreciated value to the lender when the borrower sells the house in addition to paying off the mortgage. So if you're in a shared appreciation mortgage when you sell it, say you had a 30-year loan that was a shared appreciation loan, and then you sold it after 15 years, same kind of setup, you'd still have to pay off in a similar fashion the loan balance that had not yet been paid off, and you'd have to pay off a portion of the appreciation that had been agreed upon, meaning the increase in the value of the property to the bank as well. The appreciation amount that's paid to the bank is called the contingent interest because you're giving the lender an interest in the appreciation value of the property. The contingent interest is agreed upon upfront and is due to the lender upon selling the property. So obviously when you make the agreement then for this shared appreciation mortgage, the agreement then is going to say, hey, I want a lower rate in order to give you a piece of the appreciation in the property. Obviously that appreciation piece, the percentage of the gain, would have to be agreed upon beforehand, as well as the terms as to when you have to sell the property if there's any kind of restrictions of that nature. So the bank will usually offer a lower interest rate on the SAM. So variations of the shared appreciation mortgages. Now these are like less standardized, so you can imagine a lot of different little twists that can go into play if you do this type of arrangement, because obviously the bank is kind of going in as kind of a partnership in your investment in some way. You're giving them an interest in the earnings or the increase in the value. So they can have various contingents built into them. It could include a phase-out clause whereby it could phase out entirely or reduce the percentage paid to the lender over time. So the clause encourages the owner not to sell the property and to pay back the mortgage loan. So you could have it set up so that it's going to basically phase out over a time frame so the bank gets paid off and still incentivizes you to hold on to the property. With some clauses, the contingent interest could phase out completely, whereby the homeowner owes nothing at the time of the sale. So more variations include another variation of the phase-out clause can stipulate that the borrower pays a percentage of house price appreciation only if the home is sold within the first few years. So they might say if it's sold because they're concerned about selling it basically immediately, possibly. So if they say if you sell it immediately, that's when we would want to get our percentage. A typical phase-out term would stipulate that 25% of the value appreciation be paid to the lender if the borrower sells within 5 years, for example. So what would happen, like in practice, when might these kind of mortgages be used? Now remember, if you're a home buyer, you're purchasing the home to live in, then you're typically probably looking to lock down for the 30 years. If you're going to get there for 30 years, you'd like to get the fixed kind of rate. If you're going to be living in it for a shorter period of time, or if you're in a situation where you're purchasing the home and fixing it up and then selling the home, then this could be an area where it might be more likely to happen in those kind of instances. So sometimes used with real estate investors and house flippers. Flippers are those investors who purchase and renovate a property in the hopes of turning a profit. So if you're doing the flipping kind of situation, that could be a way to get those lower rates up front and have the shared profit possibly eating into the profits, but at the same time possibly lowering the risk of getting caught in something like an arm or something like that, because the risk related, of course, to an adjustable rate or something that's going to be adjusted with inflation is the situation if you're flipping or something like that, that the house market actually goes down. So now you've got the house possibly going down and being underwater, for example, and the home value being less than the value of the loan. And then you have inflation going up at the same time so that your payments go up and getting like locked in that kind of situation. So that's kind of a risk for some of the conventional ways to try to have a short-term loan with the rate being flexible or adjusting the balance with inflation. So the SAMs for flippers tend to work best in a rising real estate market. However, this type of home loan often has a time limit on the repayment of the balance. So in other words, again, the bank's going to want to say, hey, you can't just hold on to the property like forever and never pay us back, right? They might have to put some limit on when they want to get paid back, and so on, which could, again, lead to that situation where, if there's a downturn in the housing market or something like that, that's, of course, when people that are in the market and doing the flipping kind of thing could get caught, right? You want to make sure that you're planning in some kind of way that you're hedging against, you're doing a long-term planning that you could survive through the once in a while that dip that happens in the housing market that could be, of course, catastrophic given the fact of the amount of investing that goes in when you're dealing with real estate. So properties not sold by the deadline usually have refinancing of the remaining balance at the prevailing market rate. Another use for shared appreciation mortgage is when a mortgage loan exceeds the value of the home. So if the mortgage loan is higher than the value of the home, in other words, it's underwater. An underwater mortgage can occur if the housing market declined following the home purchase. So again, that would be that situation where the housing market goes down. Now, normally you would expect, under normal conditions, you would say, hey, they got 20% down or something like that. That's why the bank collects that 20% down, because they're hoping that if the housing market goes down, it's not going to go down below the 20%. But it's possible that, of course, that could happen. And you can, of course, have situations where less money was put down and so on. So you end up with this situation where the loan is actually higher than the value of the home. The bank might offer a loan modification to reduce the mortgage debt to match the lower market value of the home. In return, the bank could ask for the loan to be modified to a shared appreciation mortgage. You would expect if there was a downturn in the market like that, then possibly if you hit the floor, maybe the market price would be going back up at some point in time. And if that were the case, a shared appreciation mortgage could be a way to remodify the loan possibly and make everybody happy, still giving the bank the piece of kind of the action on the increase when the loan goes back up, or the real estate, I should say, the price of the property, the real estate goes back up.